Evening traders, it is Sunday, March 1st, and I want to do a market recap here. I know last week's price action got a lot of people very, very nervous. Everyone's wondering what's happening with coronavirus, what's going to happen with the market this week. Personally, I believe that we're going to see a pause. We're going to see a bounce in here somewhere. You can see how the market sold off pretty dramatically on Friday. We were heading into a weekend. Fridays have typically been very weak. We do have month end, and if I go into a 5-minute chart, you can see massive buying in the last 15 minutes of trading. That is a 70-point S&P 500 rally. So what happens when you get these big events like this? Funds have to adjust their portfolio, and that's exactly what was happening. We had a huge rally in bonds, a huge sell-off in the market. So on a weighted basis, funds are under-allocated stocks and over-allocated bonds. So they have to sell some bonds and they have to buy some stocks. So that's one of the reasons that we got a big push toward the end of the day. We also have end of month, beginning of the month fund buying. And there are a couple of other factors. Up in here, we had the VIX and VXX at historic lows. Well, that has adjusted in the course of a week. You had asset managers who were under-hedged. They got their protection. They shorted the S&P 500 futures. They bought puts. They did whatever they needed to do to get themselves hedged. So that selling impetus that we saw here from an institutional standpoint is gone. You also had bullish speculation off the charts for retail investors. So that also was accelerating this move down as everyone started to bail out of their positions. You also had a lot of investors who have been in the market for the last 10 years. The last 3 years have shown a 50% gain. A lot of people very willing to take money off the table. When you start to see selling like this, a lot of investors start wondering, gee, is there something I don't know? Maybe this is a lot worse than I thought. You start watching the news, you start getting those headlines, all of a sudden panic sets in, and you've got a lot of programs selling. So all of this has contributed to this huge market decline. So over the weekend, we got some news out of China. I was waiting for those official PMIs. They came in at 35.7, which is a big drop. Now, anything below 50 indicates contraction. We were expecting a really, really bad number. They have basically shut down 70% of the country, and this came during the Chinese Lunar New Year, so we knew that this was going to have a dramatic economic impact, and it still will have a dramatic economic impact. This is going to take a very long time to recover from, so we should not expect that this is a one and done sell-off. We're going to bounce right back and slingshot back up to the high. Not going to happen. This is going to take a long time to play out. I'm simply suggesting that we could see a pause. I think that we're going to see a little bit of a bounce. I'd like to see us get up to that 200-day moving average this week. I think we'll be able to. We should have some decent economic data points coming out of the U.S. Now, everyone's going to view those skeptically, knowing that the hurt is coming. We are going to start to see some slowdown. In fact, the Port Authority in Los Angeles said that their shipments are down about 25% already from China. There are a lot of those workers who have already been laid off from work. There are some silver linings starting to happen as well, but let's talk about the negative aspect of it first. We're starting to get some coronavirus here. It's starting to spread around the world. We're starting to have corporations restrict travel. We're having a lot of big meetings called off because of the virus, and that's going to have an immediate economic impact. So we still have to get through all of that. But in terms of the bright side of things, 80,000 people in China have contracted coronavirus. That is a massive population. So you can see that even though the fatality rate is 2.5%, still not that many people have contracted it, at least not using the current methods that they use to gauge who has it and who doesn't have it. They are starting to go back to work now. We know that the coal consumption for power generation is down 45%. This is a reading taken on February 20th. So very, very slow trying to get things back on track. Traffic is down about 75%. So that's another sign that people aren't heading into the cities and working yet. Although Apple has started to open its stores back up, Starbucks is starting to open its stores back up, so they're starting to get their feet back on the ground, and this is after 2 months. So that wave is probably going to filter over here. It is going to weigh on the market for quite a while. What about the panic? Will we see additional selling? We could. My suspicion is that we're going to stabilize this week after a huge market drop. You're going to have some shorts in here who are going to take profits on their short positions. You're going to have some asset managers who feel that the brunt of the blow has been taken and that perhaps they don't need to have as much hedging on right now, that they would actually be willing buyers here. So they start lifting some of their hedges off, and that starts to get the market cranking up a little bit. I'm expecting us to try and get up to that 306 level on the SPY. Now, if we do get up to 306, whenever this rally starts to stall, that's when I would be a little bit skeptical, and that's when I would be looking to sell some out of the money bearish call spreads, kind of leveraging off of that 100-day moving average. I would be very, very cautious in doing this. You don't want to be early on this trade. You want to make sure, absolutely sure, that this rally has stalled before you do that. Now, we're probably still about a week to 2 weeks away from a really decent bounce running up and stalling. So this week, the way that I've positioned myself, you watch my video, I released this last Wednesday night. We were already in a bloodbath. And what did I do? I sold out of the money bullish put spreads Thursday morning. Now, mind you, this is Thursday morning right in here. And that's what the market did when we came in. So we started selling these bullish put spreads, and these are the stocks. You may have watched the video that I did. We sold the Microsoft March 6th. Those options hopefully will expire this Friday. That is the expiration date. And we went way out of the money on them. We sold the 155 puts and we bought the 152.50 puts, and we did that for a credit of 50 cents. So you can see here how the stock got right down to our strike price, but it bounced back immediately. So I'm feeling pretty good about Microsoft being able to hold that 100-day moving average this week. If it does, our bullish put spreads will expire worthless. So I'm feeling pretty good about the Microsoft spread. We're currently about 7 points out of the money on that with a week left to go. I like it. NVIDIA, we'll do a quick check on that. I am going to show you some stocks that I like taking positions in, and I'll show you how to take those positions in a few minutes. So please let me recap these stocks. NVIDIA, look at that gigantic bullish engulfing pattern. Man, was that a good pick. So on this particular stock, we sold the March 6th, 227.50 put. Stock never even got close. Look, that's the 100-day moving average. It's still, those options are way down here. So we sold the 227.50s and bought the 225s for 50 cents. We also, on spot, which I believe spot will do just fine, we're way out of the money on that. We sold the 130 puts and we bought the 129 puts. So you can see the stock did dip down there on Friday. We've had the S&P move 200 points against us, and these spreads are still in good shape. Right now, we're 7 points out of the money with a week left to go. We sold that spread for 20 cents. Twitter was the last one on the list. We actually got a really decent credit for this. We sold the 33 puts and bought the 32.50 puts, and we did that for a 20-cent credit. So we're risking 30 cents to make 20 cents, almost a 50-50 risk-reward ratio. I liked what the stock did. It finished higher on the day. It looks like it's going to try and get through that 100-day moving average. I like all four of these candidates. I especially like where we got in on these spreads. By the way, the S&P futures are down 35 points overnight right now, so we can expect a little bit of weakness tomorrow morning. I welcome that weakness. I want to see weakness, because I want to have that bid checked in the market. And tomorrow, we're going to see if some of that 70-point rally that happened on Friday is going to be taken away. So if you take 35 points off of this, that puts us somewhere in the range of about the probably, I'm trying to see here, 292 level-ish, I would say. Excuse me. No, that puts us right at the 293, 292.50 level, which would be right in here, which is basically this last long green bar. So the market should open somewhere in this range. We still have the low of the day from Friday. That will be our support level. So I want to see some heavy selling early, and I want to see an instant reflex, an instant bounce higher. If I see that, I'm going to feel pretty good about taking long positions because I'll feel that the weekend has passed us. We've seen buying on Monday and Tuesdays over the course of the last month. And I want that hurt, though. I want that hurt early because if there is support, we're going to see instant buying. And if I see long green candles stacked one on top of the other, and I see that in the first 15 minutes of trading, I'll feel pretty dang good that we are going to have a bullish trend day on Monday. So, what happens on the downside? What would I be very leery of? I would not want to see a lot of long red candles closing on their low, and I would not want to check the low of the day from Friday. That low has to be preserved, and it has to be preserved in a big way. If we come down and we take it out right away and we check it right away, I'll be quite a bit more skeptical. I don't believe that's going to happen. And we never really did get the big capitulation low, which typically you're going to get a huge sell off, and then you're seeing nothing but green candles for about the next 10 or 15 candles, and you never look back. That's what a capitulation low looks like. Here, we kind of came down, we had some mixed bars in here, and a half-hearted rally, and then we try and get into the gap, and then we sell off. So this is not the type of formation that we're looking for. This tells me that there's still some nervousness out there, but I do feel that we're going to see a bounce for the next week or two. While all the information is digested, we sold off so hard that I think that you're going to see buyers coming in at this level. So, yes, if we see long red candles closing on their low to start the day and we easily take out the low from Friday, all bets are off, and then you've got to expect us to go down and maybe form that capitulation low. I would give that maybe a 20% probability of happening. I would say that there's probably an 80% chance that in the first 10, 15 minutes, we have a bit of selling that comes in hard, and then we bounce violently and see long green candles closing on their high. We get past the high of the day from Friday, and we continue to go higher and have a bullish trend day on Monday with some follow through Tuesday and Wednesday. How do you play that? How do you play these moves? Well, let's go back into the big chart and let me tell you how you would play this, not from a trade specific standpoint, but from an options trading strategy. You have option implied volatility is sky high in here. You cannot and you should not be a premium buyer at all. You could get the bounce that you're looking for, buy calls, and not make any money on it. How frustrating would that be to take all that risk, have the move that you thought was going to happen, and not make any money on it? You have to be a premium seller, and right here on this low, you want to be selling out of the money bullish put spreads. These are 4 good candidates, and I'll show you some more. So what happens when the market starts to rally up in here? You get up in here, you're going to start to see option premiums decrease. Let's put that VXX up very quickly, and you'll see that was a historic low on the VXX. Nobody was buying put protection. Nobody was worried about the market. It spiked all the way up to 24.75. That is a huge move. So there's been a major adjustment. Option premiums are really, really rich right now. So you cannot be a premium buyer until this starts to come way down, which in fact you do want to watch the VIX and VXX for a double top formation, because that would tell you that there is short-term support forming. So until we start to see a market rally and some of that premium starts to come up, you cannot even think about buying options. So the first thing we need to do is we need to be put sellers in here. Sell out of the money bullish put spreads. Do it on strong stocks, and this has to be a probability type scenario. And I'll show you 2 stocks. I'll show you exactly what I mean. So as we start to come up in here and we get to the 200-day moving average, and let's say that my scenario plays out and the market starts to stall a little bit, maybe by midweek or by the end of the week, we're still getting news in about coronavirus, then you could start selling out of the money bearish call spreads if it looks like things are starting to soften and roll back over again. And the reason that we don't want to buy puts is because the premiums are still going to be very, very inflated. Our time to buy premium won't happen until there's a bottoming process that has happened and option premiums start to come in. And it's hard to even imagine this, but you could sell off and flatline in a stock, let's say. I don't think that's going to happen in the market, but the market could be much lower than it was, and the VIX and VXX still decline, 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 decline. So just because the market's down doesn't mean that VIX is going to keep going up. It needs to have steady decreases every day to keep those option premiums inflated. And so eventually, when the VIX does start to come in, and that may not happen for another month or two or three. I do not know how all of this is going to play out or what the economic impact is going to be. So don't rush to that trade, but know that once uncertainty starts to dwindle, shorting the VXX will actually be a great trade. We're a long way from that. And so once that bottoming process happens, though, and the market starts to bounce, and then we start getting above the 200-day moving average, then we can start looking at buying calls and taking a long premium position. We may be 2 months from that. We may be 3 months from that. I don't know. So this is a time to be selling premium. That's what we have to focus on. So let me also state that we've got a seasonality factor with the flu coming up right now. So if we can get through the next month and a half, 2 months, hopefully that will play into our favor as far as the virus not spreading as much. It tends to be more dormant during the summer season. What I'm hearing is that if they found a vaccine in the next month or two, it still wouldn't be to market until probably September or October when it starts to rear its head again. So hopefully that'll wane. Hopefully the vaccine will be coming. Hopefully everyone won't panic. Those are all variables. We don't know how that's going to play out. So this is a time to really kind of be very, very cautious and very methodical in your trading. The one thing that I think we also can expect is in the course of the next few weeks, the Fed wants to avoid any kind of big market decline and panic. So I expect that the Fed may be lowering rates sometime soon. They want to show that they're ready to do whatever they need to do to make sure that economic growth is still intact. I think that those measures will be relatively ineffective. You have Japan and Europe are all in negative interest rate territory, so they're painted in a corner. They have nothing that they can really do to stimulate their economies, but that would be a bullish signal from the Fed. So, deep breaths, everyone. This is going to be a week where I believe we pause and possibly bounce up to this 200-day moving average. This was an overreaction. Bullish speculators have been flushed out. Asset managers are now hedged. So we should see a little bit of calmness for the next week or so. So let's take a look at a couple of stocks and how we can approach trading. And I'm going to take a look at Google. Again, a mega cap tech stock, and you can see how it almost came down to this 200-day moving average, and then it bounced. It closed on its high on Friday. Well, if you can sell a bullish put spread down here on the low of the day, which is around the 1271 level, I'm going to put up this option chain. So 1271 or lower, we've got that 200-day moving average that we're kind of hanging on to. We know that the market's going to be pulling back. The one thing that you want to do on your bullish put spreads right now is you want to make sure that the market has to reach for you. So you don't want to be doing anything at the market, and you don't want to be waiting for that rally, because if you wait for the rally to come, you're not going to get filled on your spreads because the market will skyrocket back and you'll be left holding the bag. So if I click on this 270 put right here, you'll see that it's $20 bid offered at 22.70. Well, what the heck is that? I can't do it. There's no credit there. And look at this market here. Super, super wide. So what you have to do is you have to ask yourself, okay, there's 5 points between the strike prices. So 5 points is my maximum risk. What do I feel the likelihood is that Google is going to come back down to that 200-day moving average in the next week? You only have to get through the week. Well, if I looked at that, I would say, gosh, I'd be pretty happy if I could generate a 25 to 30% return. I think that it's much less than a 50-50 likelihood that Google will come back down to this 200-day moving average. We've already seen the brunt of the blow here. Things should settle down for at least a week and then maybe even grind higher. So if that's your mentality, what you want to do with these wide bid-ask spreads on options is to ask yourself, what do I think that probability is? And if it's 25% is the return that you're looking for on a spread like that, then you would say, well, I've got 5 points between the strike prices. If I bring in $1, I'll make $1 and I'll risk $4. That's a 25% return. And you might put the probability of success on that somewhere in the 75 percentile. While it would make sense for you to do that trade if that's how you felt. So I do actually like a trade of that nature. I would sell that spread if I could get $1 for it. Selling the 1270 Google puts, buying the 1265s and doing it for $1 credit. Yeah, I would do that. I don't know how much the market is going to come in tomorrow. I only know the S&P 500 is down 35 points overnight. So I would need to see some selling to get that spread off. So let's also take a look at another one, Amazon. By the way, Google, they have a lot of supply chain issues? No, I don't think so. No, they're all search engine related. So they're going to be impacted by coronavirus very much? Probably not. I think people will probably be watching a lot of YouTube videos. So I don't think that they're going to be dramatically impacted by the coronavirus. What about Amazon? Amazon may have some supply chain issues with some of its vendors. But in terms of consumer shopping, I would say they'd probably be more likely to buy things and stay home than to go out in a mall if there is coronavirus. So I think that Amazon would do just fine. If you take a look at Amazon, you can see the opening here, and that opening price is what I would try to leverage and go even below it a little bit if you can and see if you can get a good credit for that. So that low is 1811 on Friday. I don't think we're going to see that price again between now and the end of the week. So if I could sell a spread there, and we'll bring that up, if I could sell a spread on Amazon using the March 6th date, and I could go down to that opening price right there. Excuse me, let's see here. It's 18 is the number I'm looking for, the 1800s. So we'll go down to the 18 puts and probably the 1795s. And we'll take a look at that. Again, similar situation where these are so wide you can't even tell what you'd get. But there you have a 5-point spread between the strike prices. If you could get $1 for that, you bring in a 25% return with the idea that the stock is not going to be able to get down to that low from last Friday. I think that's a pretty safe bet, especially with this gigantic long green candle back above the major moving averages right in here. So that's how I would play it. And I would focus on selling bullish put spreads just like this, on the notion that, yes, we could see a little bit of choppy trading Monday or Tuesday, but somewhere in here, the market's at least got to take a pause. I'm not saying it's going to go gangbusters, but it could. We could see a really nice rally up to that 200-day moving average and then kind of float around and rest there for a bit. Those major moving averages are resting points for us. They are magnets, and the market is going to try and get back to those points. So my overall analysis is focus on selling out of the money bullish put spreads. By the way, if you're an investor, I am not an investor, I'm a trader, and you're really, really super nervous about everything that's shaking out right now. Typically, as a trader, and when I talk to other people, if they're super nervous about something, it means you're over allocated. You've got too much at risk. Lighten the load, take some of it off, sleep well at night. that's telling you that you probably have too much exposure to the market. Will it go back up again someday? Yes, absolutely. Is there a lot of uncertainty right now? Yes. Wait for some of that uncertainty to play out. And if you're a trader, hopefully you've been following my advice and you're almost entirely in cash right now. Well, cash is king and you are in control. The market is not in control. You are in control. There are only two times when you're in control of a position, and that's when you put it on and when you take it off. The rest of the time, hopefully your analysis is good. The market's going to do what the market does, and the stock is going to do what the stock does. So you're in complete control right now. You don't have to hurry into anything. Put those targets out there and let the market come into you. And hopefully you'll get filled on the open, because my suspicion for tomorrow is that we're going to see an early decline. That bid is going to get checked, and we're going to see an instant rally off of that low. But I don't want to see a bunch of mixed candles. I don't want to see a bunch of green and red candles like this off of that low. I wouldn't mind seeing long red candles. These are little ones, long red candles, and then long green candles with engulfing patterns, just completely engulfing all of that red. Boy, I would be a pretty aggressive buyer if I saw that. So I will be watching for it. I'm much more interested in trading the long side of the market right now than I am in trading the short side of it. So look for those bullish put spreads, look for that relative strength, try and lean on those major moving averages. Focus on that March 6th expiration this Friday. Option premiums are still very high, so you can get really decent credits and still stay out of the money. That's the strategy that you should be employing this week. I'm going to be posting my video tomorrow morning. If you like the content, please give it a thumbs up. Make sure to subscribe to my YouTube channel and turn on your notifications, because you don't know when I'm going to be posting these videos. I just felt like doing one tonight, so I hope that my video helps you position yourself for the trading week ahead. I will see you tomorrow morning. Thank you. Good evening. Thank you for watching this YouTube video. I'm Pete Stolzers, and I'm going to keep the trade ideas coming along with lots of education. So make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.